really, really key point, right? Because if I think the best example of that is the weightings in the S&P 500, right?
Correct. Yeah.
Where, obviously it's been an unbelievable decade for big cap tech, and big cap tech is currently, or within the last few weeks, anyways, was by far the largest sector in the S&P, larger as a proportion of total market cap than at any other time, other than the last couple of years in the 1990s tech bubble. And so, you've got some companies and some sectors in the S&P that are designed to do well in inflationary periods. And, if you go back and examine the returns to sectors over the past century, conditioned on inflationary environments, there's only a few sectors that actually do okay. And even the best ones don't really do that well. So energy historically has done the best with about a 1 or 2% annualized return real during inflationary episodes. Mining, gold companies, they're sort of flat to slightly down to slightly up. Healthcare, flat to slightly down, slightly up. So sadly, the sectors that should do well in an inflationary regime represent a minuscule portion of the total S&P right now. And the sectors that are most vulnerable to an inflationary regime currently represent by far the largest allocation in the S&P. So, I think this is a bad situation, especially for developed market equities and U.S. cap-weighted equities in particular.
Yeah, and we've seen that transition previously. I mean, we've lived through the tech boom where we saw tech become a very large part of the S&P. How big was Exxon in that? And then fast forward to 2008, where Exxon becomes the largest company in the S&P. Fast forward 10 years from that, and again, you see that energy weighting, those large companies S&P have become much smaller. And then, so if you're going to accept market cap weighting, then that's your allocation. And until it changes, you'll be behind the curve, I suppose. If you have a regime change, you're going to have much smaller allocations to things that do well, and you're going to have much larger allocations to things that do poorly in an environment which has changed from disinflation and growth, and the discount rate that we're applying to these growth companies into the future for 20 or 30 years. Those are going to suffer, and you'll end up with those sectors that do well, but you're just going to have a very small allocation until they grow into the new cash flows as the markets readjust themselves.
Yeah, and this is where the passive market cap weighted portfolio, cheap portfolio that everybody's bought into will suffer, and where I think active management may have opportunities at every level, right? Like from stock selection to bond selection to active long short manager selection. And in AQR's paper, what I'm showing here is kind of their view of if we are in an inflationary volatility regime, what to do. And, again, from that quadrant chart, it's not surprising that you want to diversify internationally, because generally speaking, when there's inflation, there's emerging markets that are commodity driven, that are benefiting from the rise in commodity prices. You might see other global opportunities by the fact that the dollar tends to suffer, and it's easier for international markets to compete. Within equities, again, Adam talked about it, like you're likely, if you take preemptive steps to skew towards gold, healthcare, energies, shorten duration for your fixed income, reduce credit risk, you can go to floating rate issuances, and then the alternative strategies. This is a big one. Nobody wants to do this right now, but it's reduce your private equity allocations. I think they're the most susceptible. Buy some commodities, and I think we're going to make a case also for long short multi-asset, right? This is the opportunity. I think this is where active management starts to shine again.